Hello and welcome. My name is April Showen, and I'm glad that you're joining me today. We're going to be talking all about taxes in retirement, and we're going to get into some strategies that are going to help you keep more of your money in your pocket. Because if you're planning for retirement, it doesn't matter if your income is going to be coming from a pension and Social Security, or if your income is going to be coming from a 401k or a profit sharing plan. Taxes in retirement is important, and this session is going to be for you. Because here's the thing, most people's retirement income is going to be largely taxable by default, and we can run into some surprises in retirement when we realize how much we've worked, how hard we worked to get to this place, and then how much of that income is going to go straight to the IRS. So my job today, I want to keep this simple so you walk away knowing, first of all, why does this even matter? How is it that taxes can have such a big impact on you? And how do you structure your income so more of it stays in your pocket? So I've been in the financial services industry a little over 15 years, and I really specialize in helping people get ready for that next chapter called retirement. I work with a lot of people that might be in the Florida retirement system. I work with high income professionals who have done a great job saving, but a lot of their savings are in those pre-tax retirement accounts. Think like 401ks, 403bs, profit sharing plans, drop accounts. And over the years, I've seen a pattern where people might do a great job saving, but almost no one has a plan for taxes once the paycheck stops. And that's what we're going to fix today. Last year, I had a meeting with a doctor, and she asked me a question. She said, April, what is your favorite financial product for clients? And I thought that was such an interesting question. And I first said, really that answer depends on who I'm meeting with, because what might be appropriate for you when you're 10 years from retirement may not be appropriate for the person who's 30 years, 40 years from retirement, like earlier in their career. But I told her that, by and large, my favorite thing to do with clients is cash flow planning, is tax planning. And she laughed and she said, that's the first time I've ever heard of that, because I don't think that sounds very fun or exciting. But as we get into this today, I hope that you're going to see that there is a big opportunity here for you to have an impact on what your future income looks like. And not just your future income, because we don't want to just think about this income that's going to be coming to us, in retirement, but also what about having access to our money along the way? What about having flexibility and control now? Because the right structure, the right balance between different types of investment accounts, retirement accounts can make a big difference for you, not just in retirement, but also along the way. So let's talk about why this even matters. Well, if you have different sources of income, think like a pension, Social Security, retirement accounts, your income in retirement is probably going to be higher than you think. Because what are we told? We're told that our income is going to be lower in retirement. We're told that we're going to be at a lower tax bracket in retirement. But I can tell you firsthand from working with hundreds of clients, that's not what I see. By and large, my clients are not in lower income tax brackets in retirement. Once you stack up the pension, the pension income's taxable, Social Security is mostly taxable, income coming from deferred comp, 403bs, 401ks, drop accounts, profit sharing plans, those are all taxable. And when you reach your 70s, you're going to have to start your required minimum distributions. This is when the IRS makes you take money out, whether you need it or you want it. I think I talk about RMDs with clients every week. And I just had a meeting with a client earlier today. She's turning 73 this year. It's the first year she's going to have to start taking her RMD. And it's easy to see how when all of this income stacks on top of each other, how this can push you into higher tax brackets. It can also impact your Medicare premiums. There's something called IRMA, which is basically a Medicare surcharge. So the more money you make, the more you pay for Medicare. So these are all things that we want to be careful of. But the good news is that when you understand the system, when you understand the rules of the game, you can diversify your accounts and create more spendable income in retirement with the same gross income. Because isn't that what we want? When clients tell me, hey, I'm going to be in a lower income bracket when I get to retirement, I think it's because they think their income is going to be lower. And I always ask, is that what you really want? You've reached this stage in your life when you finally have time freedom to go do all the things you want to do. And this is when you want less income coming in. No, that's not what you want. If anything, you want more spendable income in retirement so you can go on those trips, enjoy those hobbies, have the money, have the flexibility, have the freedom to live the life you want. So that's what we're going to unpack today. So I'm going to keep this, like I said, simple, straightforward, and I'm going to go through 3 types of retirement and investment accounts so you know exactly what they are and how they work. I'm going to show you a simple framework I use with clients to help make sense of, hey, where is your money sitting at today? We're going to talk about how to mix these accounts together strategically so you can reduce taxes over time, which is going to increase your after-tax income in retirement. I'm going to show you an example of 2 people with the same income who end up with very different results, all because of how their accounts are structured. And finally, I'm going to show you how you can apply this to your own situation by scheduling a complimentary focus session with me or someone on my team where we will build what I call as your after-tax income map. This way, you're going to leave today with both the why and the how. So let's dive in because we're going to get started with those 3 different types of retirement accounts. So when I sit down with clients, one of the first things we look at is, hey, where's your money actually sitting today? Because before we can talk about taxes, we have to understand what types of accounts you already have on your balance sheet, how are you contributing to those, and how are they going to be taxed? So I'm going to show you a simple framework that I use called the 3 buckets of money. And once you see this, you're going to understand why most people tend to pay more in taxes in retirement than they have to, and how you can start structuring things differently. Well, let's talk about this first bucket of money. It's called tax-deferred. Now, this is the most common place I see people save money. It doesn't mean it's the best, it's just the most common. So this is where people have the majority of their retirement savings. These are accounts like a 401k, a 403b, a profit sharing plan, a 457, a drop account, a traditional IRA. And here's how these plans work. You don't pay taxes on the money you put in today. So you're going to get this tax deduction up front. And then the money is going to grow tax deferred. So you're not paying taxes while it grows. That sounds pretty good, right? But the catch is that when you get to retirement and you start pulling money out, every dollar is taxed at your highest marginal rate. I'm going to say that again. Every dollar is taxed at your highest marginal rate. I can't tell you how many times I have clients ask me, hey, isn't there anything I can do about this? Isn't there any way that I can not pay taxes when I take this money out of my IRA or my retirement account? And the answer is no. So, because if it's in a pre-tax retirement account, it's never been taxed. So when it comes out, that is either a withdrawal or distribution to you, or if that money, if you pass away and that money goes to your beneficiaries, it's also taxable to them. So someone has to pay the tax. So let's say you needed to take out $50,000 from this bucket. I actually just had a conversation with a client yesterday. She's buying a new car. She doesn't really want to finance it. She's going to take $35,000 out of her IRA. It's all taxable, and it gets stacked on top of the other income she already has coming in from her pension and from Social Security. And so let's say, like I said in this example, if you're going to take out $50,000, you might have to pull out $60,000, $65,000, $70,000 just to cover the taxes, depending on what your other income streams are. And once you hit your 70s and the IRS steps in and they start telling you you have your required minimum distribution, so you must pull money out even if you don't need it. That's why a lot of people can be surprised by their tax bill. They might have done a great job saving, but if everything is in that one fully taxable bucket, they don't have as much control and they have zero flexibility. One of the things that I often see with money in this bucket is that it can kind of feel like it's locked in prison. The money's there, it's accessible, it's available to you, but people don't want to touch it because they know they're going to have to pay taxes. So there's like this psychological thing that happens where we just don't want to use the money for that, even though that's the whole plan and purpose of that account. The tax still hurts. There's also another reason that another issue with these accounts. And I'm going to kind of get into the weeds for a minute, because think about this. You're in retirement. Let's say most of your assets are in this tax deferred vehicle. But even in retirement, you're still going to want assets on your balance sheet that are growing for the future to help offset inflation. Because we know that you're going to need more income 5 years, 10 years, 15 years from now than you do today. Right? So we're going to have assets that continue to grow to offset inflation. Well, retirement accounts aren't great for that because of those required minimum distributions. Because with this bucket, you can't always just let it grow the way you'd like, because you're going to be forced to take money out. So it's not that these accounts, I know I'm making these sound terrible. It's not that they're, you shouldn't have any money here. That's not the case. We just want to have balance. We want to be careful how much ends up in this tax deferred bucket by the time you retire. And what I find for a lot of people is that this is like I said, it's the most common bucket, most common account that people save money into. Why? Because it's systematic and automatic. It's something you don't think about. Think about it, it's like you checked a box to put money in your 401k, right? You signed up for deferred comp, whatever. Some of them is forced. You have to put money into certain plans because of your employer. And it's easy. It comes right out of your paycheck, goes into the account. It's like out of sight, it's out of mind. And we don't always stop to think about the long-term impacts of how this is going to affect us when we get to retirement. We also hear things like, oh, you're going to be in lower income brackets when you're in retirement. But again, that's not what I see. Or we hear like, oh yeah, you want to defer as much as you can because that means you're paying less tax today. That may be true, but it might mean that we're paying taxes at a lower rate today to then turn around in the future and take that money out when tax rates are higher and we end up paying more tax in the future. I had a mentor years and years and years ago say, if you were a farmer, would you want the government to tax the seed or the harvest? Well, your 401k, that's taxing the harvest. I put money in today I don't pay tax on. It's going to grow to a larger number in the future. And then when I pull money out of that account, now I'm taxed. So those 401ks are when we're being taxed on the harvest. I'm going to talk about in a minute our tax-favored accounts, or accounts that we generally don't have to pay taxes on. And that would be as if we got taxed on the seed. So let me show you how those counts work. So the second bucket is tax-favored, and or you can think of these as tax-free, and I'll explain that in a second. So this includes things like Roth IRAs, Roth 401ks, Roth 457 plans, properly structured cash value life insurance policies. And with these, you pay taxes up front. So you pay the tax today, then the money grows tax-free, so you're not paying any tax while it grows, and when you take it out tax-free, as long as it's structured properly. Also, let's say you had a Roth and you didn't take anything out and you passed away and it goes to your beneficiaries. It goes to them tax-free. So essentially, you're going to pay a tax today on that dollar that goes into these types of accounts, and then no tax is ever paid again. And here's why that matters. Because when all of your income isn't coming from taxable sources, you now have more control and more flexibility. So you can pull money from this bucket without increasing your taxable income. This can help you stay in lower tax brackets in retirement. It can help you avoid those Medicare surcharges. It can help you keep more of what you've earned. Again, think about being taxed on the seed, not the harvest. It's going to give you more confidence in retirement because you're not worried that every withdrawal is going to push you into a higher bracket. These are great assets to have growing for your future because of that tax-free growth, because there's no required minimum distributions. So then you're going to have more flexibility about when and how you use the money. So these tax-favored accounts can really become your tax-free inflation hedge. I'm going to say that again. These can be your tax-free inflation hedge. Last year, I met with some clients of mine that had retired from the state of Florida. They now live in Orlando, and they were looking to buy a car. They were very excited, but they weren't quite sure the best way to buy the car. Should they finance it? Interest rates were higher than they are today, so they weren't sure if they wanted to do that. Should they pay cash, pull money from their IRAs, their Roth IRAs? So we took a look at all their options, and together we decided to use their Roth IRAs to buy the car. And that one decision saved them about $12,000 in taxes. Because if they had taken all of that out of their IRA, not only would they have paid more in taxes, but that also would have pushed them into a higher bracket, a higher tier for their Medicare premiums. So they were very happy, not just about getting the new car, although they're very happy about that, but also knowing that they were making a smart financial decision. Now, the third bucket is taxable, or sometimes I call it taxed as you go. So these are non-retirement accounts. They're brokerage accounts. You can think of them as like CDs, mutual funds, stocks. And with this type of account, you put money in today after tax, and then you may have to pay taxes on interest, on dividends that accrue, or any sort of realized capital gains. So sometimes people overlook this account because sometimes it doesn't sound great. Well, I don't want to get taxed every year. And I get that. That's fair. But there are some advantages to having this account. So a few things I want to talk about on this. So first, I will tell you, these do need to be managed in a tax efficient manner. I've had several conversations recently with clients that have these non-retirement accounts, but they're not as tax efficient as they could be. So you really want to work with someone who can make sure these are going to be tax efficient, because again, it's not always how much we earn. In this case, I'm thinking about like investment earnings, but it's about how much you get to keep. One of my clients is a university professor. She's looking at diversifying her savings. So we're looking at doing a non-retirement account. But for her, we've got to make sure it's going to be tax efficient because of her high income bracket that she's already in today. Now, a few things, like I said, that there are some advantages to these accounts. In that it can get overlooked, but it really does have some advantages, especially if you're not retired yet. So a few things. You can access money from these accounts at any time. So you don't have to wait till you're 59 and a half. There's no age restrictions. There's no early withdrawal penalties. There's no required minimum distributions. There's no income limits, right? So this really gives you a lot of flexibility and control. There's not as much like IRS red tape around these. And then when you do take money out of them, only part of it may be taxable, right? So it might be part of it is interest and dividends or gains. Part of it might come back to you non-taxable. So that's where that's going to give you liquidity and flexibility, both on the way to retirement, because you have access to it while you're still working, and then gives you that same control once you're in retirement. Now, this is a little bit outside the scope of our discussion today, but these types of accounts also have advantages for legacy planning, because if they're structured properly, they'll get something what's called a step up in cost basis. Again, outside the scope of our conversation today, but if that's something you're interested in talking about, just jot that down. So, about taxable accounts and step up in cost basis. So just jot that down, and then you can schedule a time for a call, and I'll walk through how all of that works. But you can see that's a big part of it too. It's not just, what's my income going to look like in retirement, we really do have to think about it from the big picture, both while we're saving money, while we're in our working years. What about when we get to retirement? What about from like a legacy standpoint about what money gets left behind and how to put all of that together? So we don't want to think about these accounts in a vacuum or in a silo. We want to take a step back and look at the big picture holistically, again, not even just from like your own planning, but also on a larger family scale level, or like, again, from a legacy planning standpoint. So these three buckets, they're called tax deferred, tax favored, and taxable. And here's the key takeaway. Most people I meet with have almost everything in that first bucket, which is fully taxable. And when that's the case, you can set yourself up for a tax storm in retirement. So if that sounds like you, I'd encourage you to schedule a 30-minute call with me so we can look at where your assets are today and we can talk about how do you start creating more balance across all three buckets. Because when you spread your savings across all three, you get more control. This way you get to decide which bucket to pull from in retirement, depending on your income, the market, what tax rates are doing. So, and right now, this is a great planning opportunity because we're actually in some lower income tax brackets and rates right now, although there are some concerns about taxes going up in the next few years. So this could be a really good opportunity to take advantage of some lower taxes today as we prepare for what may come in the future. Because, this kind of flexibility can save you thousands of dollars and create thousands more in spendable income for you in retirement. So now I want to show you a simple side-by-side example of how taxes actually impact your spendable income and then show you the difference between if we have money and assets in different buckets. Because understanding the taxes, this isn't really just like a math equation, although that's part of it. It's really more about how much of your income you actually get to keep and spend. You can have two people with the exact same income, the exact same total savings, but if they use those buckets differently, one will end up with more spendable income every year in retirement. So let's look at an example. So let's say a couple needs to take out from somewhere on their balance sheet $100,000 a year on top of their other income they may have coming in from like a pension or Social Security. So we're going to look at first scenario A, and this is where all that income comes from tax-deferred accounts like a 401k, drop, traditional IRA, profit sharing plans. And if they withdraw that $100,000, and if they're in the 32% tax bracket, then 32% goes to taxes right off the top, and this is going to leave them with $68,000 to spend. Now, I want to take a second here and go through, we have a progressive tax system, so the more income you have coming in, it pushes you into higher income tax brackets. So that's one of the things that I'm not covering here, but I do talk about with clients. Sometimes I have clients that are going to get to retirement and they may say, hey, I want to take everything out of this retirement account, or I want to cash in my drop because I want to pay off the house. I am worried about the market. I just want to cash it out and put it in my checking account, whatever the case may be. And we do have to look at it because that large sums of withdrawals can push you into higher tax brackets. And depending on what your needs are, your goals, it might actually be better to structure that income to come out over several years. So in the example, I had a client, she was about to retire and her plan was to take everything out of she was going to cash out her drop account from the state of Florida and use it to pay off her mortgage. And I showed her a better way of, hey, if we have that drop account, go to an IRA first, and then you get to control exactly how much you're pulling out and when, and how much to have withheld for taxes. And we accomplished the same goal. We had the drop account pay for her mortgage, but it saved her thousands and thousands in taxes because she didn't have that one big hit, that one big lump sum today. So I know that's a little off my topic here of scenario A, but I did just want to bring that up about our different tax brackets. But in this example, scenario A, someone takes $100,000 out of their 401k, 32% bracket, they're going to pay $32,000 in taxes. So now let's look at scenario B. So let's say we still want $100,000, but this is going to come from different buckets. So $50,000 comes from the tax deferred bucket, and the other $50,000 is going to come from more tax favored sources like that Roth account or that properly structured cash value life insurance. So the first $50,000 is still taxable. The second $50,000 comes out tax-free as long as it's structured properly. So instead of paying $32,000 in taxes, now they only pay $16,000, and now they have $84,000 to spend instead of $68,000. That's a $16,000 difference in after-tax income every single year. And if you think about over a 20-year retirement, that adds up to an extra $300,000 in spendable income. This can make a really, really big difference in retirement. And, this isn't just about lowering your tax bill, although that certainly is nice. It's really about giving you more control. It's a flexibility to pull income from the right bucket at the right time, to give you more control over your income, how much of your income is going to trigger taxes, more confidence that you can maintain your lifestyle without worrying about some big tax surprise every year. I had a client who was getting close to retirement, and she did a great job saving, and she had money in all three of those buckets: tax deferred, she had a Roth, and then a taxable investment account. And her question was simple: how do I use all of these things in the smartest way possible? And that's what we worked through. So instead of her just pulling money out randomly or pulling money out on autopilot, we built a plan to be strategic about how each bucket would be used. So for example, we were intentional about not taking too much out of her 401k that would push her up into higher tax brackets. We used her taxable assets to supplement her income needs, but keep her in lower income tax brackets. And we positioned her Roth assets to be part of her longer term picture for growth. So this allowed her to create the income she wanted in retirement without paying more in taxes than she needed to. So when you have multiple accounts, the value is not just money saved, right? It's knowing how to use all of these accounts together in a strategic and thoughtful way. Now, I know this can sound like a lot, right? So which accounts, which buckets, how much should I pull from each? That's exactly why I offer a complimentary focus session to walk through those items with you. So you can probably see how powerful this is when you have a mix of different sources for your income. But the real question is, what does this look like for you? So this is where that after-tax income map comes in. So first, we're going to look at what you currently have in each tax bucket, how much you're contributing, and how those accounts are likely to grow over time. And then we can look at what changes you make between now and retirement, how that can increase your spendable income or reduce future taxes. And this is customized to you, right? So whether your income is going to be coming from a pension and Social Security, or if it's going to be coming from a 401k and profit sharing plans, we can look at your specific options. One of my clients, she's a physical therapist, and she was contributing to a tax deferred account. She was maxing out her Roth. She was investing in a taxable account. But when we looked at the bigger picture, we realized that most of her long-term savings when she got to retirement was still going to be in that tax deferred bucket. So instead of just looking at, hey, where are her accounts today, we modeled what her savings was going to look like over the next 10 years, and then what might happen if she made some changes. And we did decide to make some changes where she was going to reduce how much was going in that tax deferred bucket. She was going to increase what was going into her taxable investments, because that's going to give her more balance between tax deferred, tax favored, and taxable money when she gets to retirement. And what she loved most was just being able to see it side by side. It gave her clarity on like where her money is now and how it's going to be working for her. So she no longer felt like she was just saving on autopilot. She was being more intentional about the decisions she was making. And a lot of people tell me that just seeing that map for the first time kind of feels like a light bulb moment because they can finally understand, where their money lives and how it can work more efficiently for them in the future. So if you'd like help applying this to your own situation, the next step is to request our financial planning intake form. So you can click the link in the chat box or the description box, or you can scan the QR code on the screen. The financial planning intake form only takes a few minutes to complete. You'll send that back to our office. We'll review it, and then we're going to help you get scheduled with the right person, either me or someone on my team. So the first step to getting help with this is to request our financial planning intake form. This is a simple step, just helps us understand where you are today and how we can best help you. Thank you so much for joining me today. I hope that today you've seen with just a few moves, you can keep more of what you've worked so hard to earn. Thanks again for being here, and I look forward to connecting with you all soon. Bye now.